What if I told you the number one reason investors lose money in alternatives isn't because the assets were bad? It's because most of the sponsors overpaid and then structured the deal to benefit the sponsor themselves, not the investors. It's true. Most high income business owners that I talk to, they know they should be diversified beyond Wall Street, but they hesitate because if you've been watching things, they've seen people lose hundreds of thousands of dollars, even millions, in real estate syndications, funds, or private placements that looked great on paper but bled cash in reality. Hey, my name is Kent, and for over 20 years, I've been helping investors put capital into alternative assets like real estate that generate cash flow and income and actually grow wealth as well. And here's what I've learned. It's not about whether you invest in real estate or oil and gas or debt. It's about whether the structure protects your money or just the operators. So here's the biggest problem I see. Most individual investors, they don't have the time or the network to spot the red flags. They see these glossy decks and the projected returns, but they miss the over leveraging, the interest rate risk, the poor operator history, or the weak downside protection. And that's exactly how money gets lost. That's why we built the Smart Flex Fund, to flip the advantage in our favor back to the investor. Every deal is vetted through our 5-part framework, which keys in on the sponsor themselves, and then the market, the asset, and then a risk return analysis and looking at the taxes and timing. That process screens out weak deals before they ever reach you. Then we dive much, much deeper because that's where the true problems are. They're often hidden and glazed over by the sponsor. Every deal has problems and issues. That's risk. But what matters is if the sponsor has a plan to mitigate that risk or just wants to pretend that they don't exist. On top of that, by pooling investor capital, we negotiate stronger terms that protect your downside, like higher pref returns, better splits, priority in the capital stack, and direct sponsor alignment. In plain terms, you're going to make money first, not last. Now, here's a real example with one of our investors. He came along to us after, frankly, he lost some money in multifamily, and it was a deal that just collapsed under the rising interest rates. We're seeing that everywhere. But inside the Smart Flex Fund, he was able to redeploy into debt-backed alternatives, much safer with collateral. And he also did an oil and gas deal. Both were structured with that collateral and tax advantages. Within 90 days, the first distribution started to hit, and with peace of mind that their principal was actually protected now. You see, you don't need to gamble your next 100K just to diversify. You need a system that eliminates the common ways that investors are losing money, and a system that structures deals so that the investor wins first. If you're holding back because you've seen too many people losing money big in alternatives, let's talk. And if you're worried about fees, trust me, we typically negotiate so well that most of the fund fees get paid by the sponsor and barely reach the investor level. There are actually some great opportunities all around us right now if you know where to look and what to look for. So book a call at the link below, and I'll personally show you how we protect investor capital while delivering steady, visible results.